Good afternoon, everybody. Thank you very much for joining me this afternoon. Let me just do a quick check-in with the numbers up here and see how many people we've got on board. I'm having a couple of technical issues because I've actually recorded this this webinar for our franchisees, and there's some sound over the top of it, and I don't know how to play the slides without the sound over the top. So I obviously don't want to do that because this webinar is live. So thank you very much for joining me. Really appreciate you spending some time with me on this Tuesday afternoon. Feels like a Monday. I keep wanting to say Monday, but it is Tuesday afternoon at 1 o'clock. This webinar is all about what's going to happen if the R word becomes true, if there is a recession coming up in the next 12 months or so, which, let's be honest, it looks like there is. But what can we do to prepare for that, and how is that going to affect the property industry? And what I want to do with this webinar is, first of all, I want to just understand a little bit more what the R word means. What do we mean by recession? And what can we expect? Because it's really easy to not completely understand what a term like that means and the economic impacts of it. And then hear it on the news, hear it on the radio, hear those financial reports that come out on, every month or so, and allow ourselves to be, well, I can't think of a better word for it than panicked by it. And then as soon as you sort of hear that word and you allow the tone of the news article to sort of dictate how you're feeling about it, then all of a sudden you're reacting to it. Rather, what we want to do is we want to prepare for it, we want to understand it, we want to plan for it, and then we want to see the opportunities in it. And so that's what this webinar is about, really. Now, I apologize, but if I put my slides on, if I max out the screen, then the audio starts playing automatically over the top. I am going to try something else to try and make it work, and hopefully it won't. But I think that's going to be a problem, so I might have to show it to you in this view, which is a bit unfortunate. But here we go. We adapt and overcome, don't we? So first of all, if you could please just let me know in the chat box above if you can hear me. I've done like 2 minutes worth of talking before I've asked you that question, which is a bit of a mistake, but here we are. If you can let me know that you can hear me and just pop something in the chat box to let me know, that'd be fantastic. Just a quick yep or something similar. And while we're at it, while we're looking for the chat box, if anybody can put something in there just to say that you can hear me, that would be great. And while we're at it, we've got two things. Oh, chat is disabled. Thank you very much for letting me know. Well, that's good, because chat is always a bit of a problem when people are asking questions. So thanks for letting me know that chat is disabled. That is actually a much better thing for me. If you've got any questions, then you've got another option on your screen, which is a Q&A. So please use the Q&A box to put your questions. The reason that Q&A is better than any other method is that I have to say that I've seen and answered that question before we move on. So if you can do that, that'd be great. I can hear you. Looks like chat is disabled. Thank you very much, Helen, for letting me know, and John and Trevor. Okay, so and Carol, thank you very much, Carol. Just got yours in as well. All right, okay, so if you've got any questions, please put them in the Q&A box. I might not answer them there and then. I might wait till the end because it's just me doing this on my own. So I might think that it's more appropriate to look later on. But thank you very much for everybody else that said that they can hear me. That is terrific. So it looks like that part of what we're going through today is working at least. So let's get on to the first slide. So let's have a look at the things that we're going to look at. So the market over the last 12 months is the first thing that we're going to look at today. Then we're going to look at what changes we're currently seeing, what signals, what identifiers are we currently looking at in the market, and which direction is that leading us to believe that the market is going to go. And then we're going to look at what that means to you. And if that means something to you, what's the best way that you can prepare for that? And then the final thing, which is probably the most important thing, is the media influence that you're going to see and how you can best prepare for that as well. Because it's very, very, very easy to, start off with an idea as to how you're going to prepare, what you're going to do about something. But then you hear all of these media news stories and you start to believe that, that hype and that angle that they're coming at the problem on is the only way of looking at it, rather than taking a step back, thinking objectively, and then planning a way forward. So with the next one, I'm going to see if we can There might be some noise that plays over the top of this. And if there isn't, oh, there you go. I knew that would happen. So let's just go back off there. So I can't play it without the audio. So we are stuck with this view, but that's where we are. So first of all, let's look at the market over the previous 12 months. So what has the market done over the previous 12 months? These are property prices, and they go back further than 12 months. This isn't just what has happened in the last 12 months. This is all the way back to January 2007. So about 15 years worth of data here. And you can see that in the beginning of January 2022, which is on the far right-hand side, the increase that the property market went through between January 21 and January 22, so the whole of 2021, was the fastest increase of the last 15 years. Now, with that in mind, I'm sure that comes as no surprise to anybody. We all know that property prices have been going up. We all know that properties have been listed on the market and have sold within minutes, and that really, buyers have been driving prices because there's been so much demand over the last couple of years for property. There's so much demand and so little stock in comparison to the demand that prices have really dramatically gone up. So that's one thing that we're aware of from the last 12 to 24 months. Another thing that we know of is that, first of all, at the top of the page there where it says fewer products, we know that mortgage products are starting to become withdrawn from the market. Now, this isn't over the last 24 months. This is sort of within the last 6 months or so. Now, lenders, I described lenders for the first time the other day as the deer of the property world. And you know what? I think that's a pretty good definition, because they are very, very, very nervous creatures. They are the first to run away as soon as they see a change happen, or as soon as they start to feel like they're being threatened. And that's absolutely accurate. They've got a lot of money invested within property, and so it's absolutely their right to be the most nervous. But as soon as they detect that something is going to affect the property market in some way, then they tend to withdraw products. They take away what they see as the more risky products in the marketplace. Just got a question, so I'm just going to have a quick look at that. Cannot hear you, Hitesh. Oh, there's not much that I can do about that now. People tell me that they can. Just maybe check that your speakers are on, but there's, you're not going to be able to hear me say that, so that's unfortunate. So yeah, thank you, Trevor. Trevor can hear me fine. So yeah, fewer products on the market. Was it last month? No, we're towards the end of August now. So July, in June alone, 500 mortgage products were removed from the market across across multiple lenders. So this isn't just one lender removing mortgage products, but each one of those mortgage products, each one of those mortgage deals would have been sold to multiple people. Like it's the I don't know, the NatWest 4.99% fixed for 10 years deal has been removed from the market. 500 of those individual products were removed from the market. And what lenders would have been doing during that time is they'd have realized that a change is going to happen to the market, and they would have removed products that they see as more risky, right? So, let's say, for argument's sake, a buy-to-let mortgage versus a serviced accommodation mortgage. Well, serviced accommodation has been shown over the last couple of years that it is intrinsically a more risky thing than buy-to-let, because the demand for serviced accommodation can go up or down. And therefore, lenders might remove their serviced accommodation product, but they might leave their buy-to-let product on the market. Now, please bear in mind that these are just examples that I'm giving you. I'm not saying that that's definitely happened, but what they do is they remove their risky products from the marketplace. Another change that we've seen, and again, I've taken this data between Q1 and Q3 of 2021, is prices for building materials has dramatically gone up. I mean, look at timber on its own. Just in one quarter, in 2021, timber went up by 78%. That is a massive rise. Steel, similarly, 77%. But across the board, prices were going up. So we've seen not only property prices going up, but we've also seen that the price to create property has gone up as well, because of the materials prices that that have gone up in price over the last 12, 24 months or so. So we've seen rising prices. We've seen a very high demand and low supply, which has really driven property prices up and up and up. materials prices rising as well. And this started off by being a byproduct of COVID, didn't it? Because, you know, COVID struck and supply chains were hit, and fewer people were putting their properties on the market, but there was still quite a lot of lending products available. So people started to look for other properties, look for things to invest in property, because again, they saw that property was you know, a very good investment in comparison to other investments that they, you know, for example, the stock market. And so that started to drive that supply and demand in property in favor of the people that owned the properties. And then, of course, Ukraine happened and Russia invaded Ukraine. And at that point, we saw a very, very steep and very quick rise in fuel prices. And of course, the thing with fuel, when fuel goes up, is that it affects everything. Anybody that's delivering something to you all of a sudden has higher costs, and they put that onto the products that they're delivering to you, or the cost of delivering, and then everything becomes more expensive. And that's driven, you know, started off by COVID, then driven by fuel prices. That continues to drive the price of products higher and higher. Although saying this at the end of August in 2022, fuel prices have ever so slightly started to come down in my local area. My local BP petrol station peaked for diesel at 197, and it's gone down at the moment to 185, and it's been fairly stable at 185 for the last couple of weeks or so. Now that might be a plateau, it might be a trend. Who knows? Only time will tell. Let me just go back into the questions. Thank you all for telling me that you can hear me as well. Okay, so that's the market over the last 12 months or so. That's, you know, everything that's been affecting property. We haven't got into interest rates yet, but we shortly shall. So what changes are we currently seeing? So you might need to zoom into this, but this is inflation over the last 12 months. And the important number is this column right down here. So you can see in May 2022, inflation was at 7.9%. Now, over the last couple of weeks or so, we've seen that the prediction for inflation goes all the way up to 18%, which is a big old scary number if you don't understand exactly what inflation is, especially if it continues to go at 18%. Let's have a look at inflation since 1975, because, you know, the 70s and 80s, inflation was up and down a lot more than it has been in the last decade or so. And you can see that inflation went up to about 17% around 1980. And then since 2007, 2008, it came down since the credit crunch, and it has stayed very, very low since then. But on the very far right-hand side, you can just see that it started to go up again. And that's because of the recent changes by the Bank of England. And in fact, there should be a new graph now, which goes a little bit higher than this one ends up on the right-hand side. But interest rates are going up. And interest rates are going up because inflation is going up. So inflation rises, and the Bank of England raise the interest rates in order to control inflation. Now, if you don't understand how that works, I am going to explain this with a couple of slides in just a moment. So don't worry if you're not currently with me. We'll go through it in a bit more detail. So what changes are we currently seeing? We are currently seeing that inflation is high and it is going up. You know, May was almost 8%, and we're seeing that it's going to go up as high as 18%. We're seeing that rising interest rates are rising in line with inflation. And at the moment, property listings remain fairly strong. You know, you don't see that there's a big drawback from people that are listing their houses on Rightmove. I'm still getting just as many emails with just as many properties on from Rightmove as I have over the last couple of years or so. So property listings currently remain strong. There are fewer products on the market from lenders, which is absolutely accurate. And that therefore, because there are fewer products on the market, there are fewer buyers or investors looking to buy. Now, this is really right at the peak of the sort of warning signs that property is no longer going to rise at the rate that it has been for the last couple of years or so. Yes, property listings remain strong, but the reason that they remain strong is because people who are wanting to time the market and wanting to sell at the absolute peak have waited a little bit too long. They've waited for the warning signs that the prices are going to potentially dip a little bit, And that's when they're chosen to put their property on the market. You know, oh, there's going to be a crash. Let's put the property on the market and let's get it sold as quickly as possible, is the kind of reaction that we're seeing from people that are putting the properties on the market now. Realistically, if they wanted to sell at the absolute peak, they probably should have listed it about 6 months ago to make sure that the prices don't come down at all. However, listings are currently remaining strong. We expect that to change fairly promptly, and let's go into exactly why that is. So the direction of the market. So let's have, first of all, I wish I could animate this slide because I've got it in stages of animation. So I'll just talk you through it with my mouse. So let's have a look at inflation and interest rate. So let's say the Bank of England interest rate is at 1.5%. This chap here, he's got an income of £1,000 per month. And of that £1,000, he spends £300 on his mortgage. Now he's got £700 disposable. So what he does is he goes to the blue shop and he buys something for 150 quid. He buys something for 200 quid. And he buys something for 250 quid from each one of these relative shops. And then from the grey shop at the bottom, he buys something for 100 quid. Now, these shops, and that comes to, have I done my maths right? Does that come to exactly? It does, doesn't it? 700 quid. Perfect. Now, these shops, they might, you know, get a delivery of the stuff that this guy's buying. Let's make it really easy on the 1st of the month. And previously they'd sell out on like the 25th, 26th, 27th of the month, that kind of thing. But because their supply chain is being hit originally by COVID, and then secondly by Ukraine, by the invasion of Ukraine, now they're only able to get 10 of these products per month instead of previously they bought 20. So they've only got 10 per month, and now they're selling out on the 10th of the month, or the 9th, or the 8th of the month. So they're going through, you know, 2/3 of the month without actually having any of these products to sell. But people are still knocking on their door saying, "Have you got any of that stuff? I really like it." "Oh no, sorry, we sold that by the 10th of the month, unfortunately." So now these guys are thinking, okay, so I've clearly got a market for this stuff, right? People want this stuff. There's a lot of demand for this stuff, but there's not a lot of supply. Now, if I put my price up from 150 in the case of the blue shop to 160, all right, instead of having 20 people buy 20, I've now only got 10, but I've still got 15 of those 20 people that would pay 160 instead of 150, then they're still going to sell out of those products. So now people start to raise their prices because the demand is still there and the supply has dropped off a cliff. So now if you look on the right-hand side, if you go from March, these are the prices in March when this chap was buying all this stuff. And in April, every one of these shops decided to put their prices up because the demand was really high and they couldn't get enough of those products. So prices go up, and that is inflation, where the supply is not enough to meet the demand, and therefore that drives up prices. Now let's scoot forward a month, and now we're looking at April, and now we've got 160, 210, and 265, which is the price from the raised price from the previous slide. But now the Bank of England have put up the interest rate. So now it sits at 2%, which means that this chap, he's still earning £1,000 per month, but now his mortgage has gone up. It's risen to £350 repayment per month, which means that he's now only got £650 disposable. Now, if you take into consideration the inflation and his lack of disposable income in comparison to the previous month, now he buys from the blue shop as he normally would, and that cost him 160. He buys from the green shop for 210, and he buys from the pink shop for 265. But now he's only got 15 left to spend in the grey shop. Now he can't spend that in the grey shop because what he bought from the grey shop, let's just go back to the previous slide, is now £110. So he doesn't have enough money. But instead of taking that 15 quid and going to spend it in a different shop, he's now got a very different mentality because he's thinking, oh, interest rates are going up. There is inflation. Instead of spending this 15 quid and putting it back into the economy, I'm going to keep it. And I'm going to make sure that I look after myself, which is absolutely reasonable and the kind of reaction that many, many people have. So now in May, instead of going up, these prices now stay the same because there are fewer this rise in interest rates has now affected lots and lots of people, which means that there is are fewer people out there purchasing products, and therefore it has it's slowed down demand. So it's stopped that demand that had been there the previous month, because there is less disposable income around. Now, how does this affect the shops? Well, as you can see from the grey box at the bottom, that shop has had to close down. And you hear about businesses closing down during recession, when the economy is no longer growing, when the economy is shrinking. And the definition of recession is that the economy shrinks for 2 quarters in a row. If the economy shrinks for 2 quarters in a row, there are probably going to be there's less disposable income out there, probably because the Bank of England has raised the interest rates, which means that some shops will not survive. Some businesses will not survive. And, you know, that's very sad. And it affects lots of people. You can see here, this shop employed 8 people, and it's going to affect their lives, obviously, because now they need to find a job. But there are less jobs in the marketplace. There are less jobs in the economy because there's less disposable income from the average consumer. So that's how inflation and then interest rates impact the economy. And as you can see, what happens when inflation has been happening for a number of months, and then the Bank of England put up the interest rates, that can stop inflation, or that has a knock-on effect to stop inflation or slow inflation, because it slows down or it reduces the amount of money flowing through the system, and therefore it slows down demand. So that's what you're going to hear in the next 12, 18, 24 months, however long it is. That's what you're going to hear about. You're going to hear about inflation, you're going to hear about interest rates, and you're going to hear about recession. And that's basically the system that we need to understand in order to make sure that we can then plan for how we're going to react to that. So the direction of the market is, we're predicting that inflation is going to continue for the mid to long term, and then will level out. If you think about the way that inflation started with COVID, and then because of what happened in the invasion of Ukraine, it then went up again very sharply, and then since then it's sort of leveled off. So for the next, I'd say 18 to 24 months, inflation is going to remain pretty high. But then after that, it's going to level off and then come down fairly quickly, because inflation is the comparison between the price of a product this year versus last year. So if it goes up fairly quickly and then levels off, you know, inflation will go up fairly quickly and then it will level off. Interest rates will rise in less time. Now, the Bank of England needs to be very careful, because what happens is they put interest rates up, and then it takes a little while for that impact of the interest rate rise to affect the economy, to affect inflation. So they don't want to put interest rates up too quickly, because they could put them up too far and really damage the economy, and then bring them down too quickly. But what they want to do is and this is exactly what they've been doing. They've been going up in smaller increments and doing it fairly regularly. Now, my prediction would be that they're going to, you know, go up to, say, in whole numbers, and then leave them there for a couple of months, and then start to raise them again. And the reason that they'll do that is so they can test and measure a lot better how much the interest rate rise that they previously put on is going to affect the market. Now, the impact of that is that families are going to have less disposable income, which means that there are going to be fewer people looking at property investments, right? And there are going to be fewer lending products out there, because the lenders will continue to remove their lending products from the market. And as described earlier, vanilla products are going to remain on the market, because vanilla products, lenders are fairly happy that they're going to have the security that they need to continue to lend on those vanilla products, whereas the more risky products are going to be withdrawn first. Now, if you think that families, or, you know, it doesn't have to be families, anybody is going to have less disposable income if they're subject to these interest rate rises. Personally, about a year ago, I put all of my mortgage products onto fixed mortgage terms, because we could see that something like this was going to happen. I hope that you did too, and that means that this interest rate rise doesn't affect me as much as it would affect somebody that's on a variable rate that's determined by the Bank of England base rate. So vanilla products will remain out there, but basically, because more people are going to have less disposable income, and because there are fewer lending products out there, and probably with tighter terms as well. So, you know, lenders could remove their 90% and 90% buy-to-let mortgage, but they might go back to a 70% buy-to-let mortgage, which means that if you did want to buy that same house, you're going to have more money in your pocket. So because there's less liquidity in the system, there are fewer buyers out there. There are fewer buyers out there to get involved in property, which means that the demand of property has really reduced. Now, as well as the demand in property really reducing, we've seen previously that people are desperate to take advantage of this peak of the market, and therefore they're still listing their properties. So now, instead of having few property listings and loads of buyers, we've now got loads of property listings and very few buyers, which means that the market turns around from being a seller's market to a buyer's market. And all of a sudden, those that are still out there and active and engaging in the property market have now got all of the power. All of the power to negotiate, all of the power to get the deal that they want, rather than having to stick to the vendor's terms. It's now the time for the buyer to take control for the next couple of years or so, and really, you know, get the best deals that everybody else misses out of. And in 5 years' time, everybody says, "Oh, I wish I bought back then." Well, this is now. This is happening now. We need to prepare for this. So prices are going to stagnate for the properties and potentially even decrease. And yet, you know, there are going to be areas of the country, if not the whole country, that where property prices are going to go down. Fully expect that. That's just part of the cycle. It doesn't, you know, it's not something to panic about. It's just something to bear in mind when you're choosing your next opportunity. So properties are going to stay on the market for longer, especially if you've got unrealistic vendors who aren't prepared to accept that the price of their property isn't as much as they thought it was 12 months ago. But, you know, that's just the way it is. And if those vendors don't like it, then they can wait around and potentially, you know, see their property go up in value again, but that's not going to happen for quite some time. So what does this mean to you? So there are going to be more properties on the market, or properties that remain on the market for longer. There's less competition for properties and agents become more reasonable. This has already started to happen, actually. I've had a conversation with a couple of agents now where they used to be looking for the properties. They used to put all of their spare time into looking for listings and getting new property listings because it was difficult to find the properties. And now it's the other way around. Now their attention and their duty or the amount of care that they're putting into their investors or the potential buyers is far, far better. They've already made that switch because, you know, agents are not stupid. I've had a few phone calls with agents where they're just checking in whether I'm still looking to buy, and what my requirements are, and, you know, all of those kind of phone calls is because they can see that there are going to be fewer people out there, and they're the really rare commodity, those people that want to still buy properties. So people with money are fairly rare. The ones that are still out there are going to make a mint over the next 10 years. We're also going to see that materials prices start to level and even start to decrease. Now, in the next 12, 18, 24 months, I don't predict that they're going to be down to the same level as they were pre-COVID, but they're certainly going to get more competitive because supply chain issues are being, if not, you know, back to the same level as they were before, they're at least being handled, and the people that are supplying the products have, you know, thought of ways around those problems. So that's what we're going to see over the coming future. So how best can you prepare for this? So first of all, you need to understand lending products that you can use. Now, you know, you need to have a realistic look at what you've got and what you need as a lending product to enable you to move forward with property. So if you have a big pot of money sitting there because you've withdrawn it from stocks and shares, or you've taken it out of your pension, whatever the reason, if you've got that big amount of money sitting there, there's still going to be some lending products that are out there on the market that are available to you. For us, our franchisees still have source capital that they can go to, and source capital will lend to them at 70% of the GDV. And the rates that source capital will lend to our franchisees is exactly the same as it was before COVID and before Russia invaded Ukraine. Source capital have not changed their prices whatsoever. So we still have this facility to allow our franchisees to capitalize on the next 12 to 18 months. And that's only available to our franchisees. Liquidity provides opportunity. So one of the things that we've been doing over the last 3 or 4 months is that is we've been improving our liquidity. So we've been looking at all of our investments. We've been looking at, our overall cash flow, and we've been thinking of ways that we can improve and grow that pot of money that we have sitting there waiting to invest in property. Because we know that maybe not now, maybe not right now, but certainly in the next 6 to 12 months, there's going to be some amazing opportunities that potentially might have been on the market for a long time, and only now the vendor is willing to take an offer for that property because they can see that the market is turning, and they believe all the hype from the news agencies. And so we're looking to build our pot of money. Now, if you're not able to do that, then you need to spend more time looking at what lenders are open in the market that you can take advantage of, that really suit your situation. So with our franchisees, what I mean by that, they can borrow 70% of the GDV. If you work out the purchase price of a property and you work out the costs of the property, they can potentially borrow all of those, the purchase a commercial building and turn it into a block of flats. Then we'll look at the value of that block of flats, and up to 70% of the value of that block of flats is what our franchisees can borrow to get that project done. If you do have access to lending, then I would very strongly advise that you absolutely hammer home your access to lending. You tell people that you've got access to lending. You tell people that you've got funds, because then the agents are going to be all over you trying to find a deal that suits your criteria. And in the same breath, you need to be very strong with the agents, because the agents will try and get you to buy anything, buy whatever's on their books. But you work with the ones that are listening to you and only sending you properties that suit your criteria. And then you can move forward and you can purchase that property. As well as that, you want to build relationships with builders now. Now, the last time, 2007, 2008, the last time we had a dip in the market, in the property market, builders were basically doing work for cost just to stay afloat. Now, to be perfectly honest with you, I don't see that this dip is going to be anywhere near as strong as the 2007, 2008 dip. If you remember, that was called the credit crunch, and the credit crunch came about because there was an intrinsic problem with the way that banks and money lenders categorized property, and that was systemic throughout the entire system, and that needed to be dealt with, and that's why there was a crash basically in 07, 08. Now, when there was that crash in, I think it was 2008, there was only a 10% dip in the price of property, and then the following year there was a 5% dip, and then the year after that, property prices actually bounced back. So from that incredibly deep and systemic problem within the property lending sector, there was still only a 15% decrease across the board in the price of property. Now, we do not have such a big problem to overcome in this time, and therefore it would be logical to predict that that prices are not going to dip anywhere near as much as they did in 07, 08. It's going to be hard to predict exactly how much they're going to dip by, if at all. But you need to bear that in mind when you're putting these projects together, especially if it's like a big commercial conversion that's going to take you 18 months, 24 months to come about. But build a relationship with the builders now, because you build those relationships now when they're busy. It means that when it comes to the time that they're looking, they're really looking for work because there's no work out there, because nobody's buying property, and you're the one that buys the property. The competition for your work will be fierce, and you'll get much better prices than previously. Although, do expect that materials prices will still be higher than they were before COVID. So what you need to be aware of over the next 12, 24 months is the media. Personally, I don't watch the news very often. I stay on top of things by reading websites of impartial news providers. But you will hear a lot of hype about recession, and it'll be the doom and gloom recession. And absolutely, for those people that have lost their jobs, for those people that have shut down their businesses, yes, of course, it's not a pleasant thing. But if you're fairly secure and you're not going to lose your job, and you have a pot of money by your side, or you have access to something like source capital by your side, then potentially you could increase your portfolio significantly in the next 24 months, and set yourself up for the rest of your life. So recession is something that you're going to hear about a lot, but please be aware that how recession works, and that this is just a part of this process. And yes, of course, some people are going to lose their businesses, but as soon as we come out of the recession, the economy will start to grow again, and hopefully they'll be in a position to look to start a different business or start a new business. Property values dive. Now, whenever I see headlines like this, I always make a point of looking at the numbers, because the media will use those numbers and they'll come up with a way of presenting those numbers that makes it seem really much more dramatic than it actually is. So it's really important for you to look at the real terms of those numbers. So speed of property decline increases by 50%. Now, what that can mean is that, 1 month, the price of property went down by 1%. And then the next month, the price of property went down by 1.5%. Now, all right, yes, that is a decrease. So why haven't they explained it in those terms? Because if it's going down by 1.1% or 1.5%, that's still not a very dramatic decrease in property. But if they explain it by saying that the price of property decreases by 50%, it sounds a lot more dramatic, because the first thing that you think of is, oh my God, what would happen if my house was worth half of what it was before this crisis? And that's nowhere near the information that's actually being provided. So step away from those headlines, step away from the media and the control that they have over this system, and just look at the data, look at the details of what they're presenting, and think about whether that's relevant or will have an impact on you at all. And then look for opportunities. Now, one of the things that we do at Sourced is we show our franchisees through our courses, we show them how to structure property deals. And the way that you structure property deals basically depends on the opportunity in front of you and the desires of the vendor. Now, vendors are going to become more compliant because it's more difficult for them to sell their property deals. And therefore, they'll be open to more creative ways for you buying their property, which could be, if you've heard of a thing called vendor finance, where essentially the vendor puts down the deposit for you to buy their property by reducing the purchase price. Well, not technically reducing the purchase price, but reducing the amount of money you need to leave on completion, and allowing you to make up for the money that you were going to put down on completion at a later date. That might be a bit wordy, so let me explain that a little bit better. Let's say that you can find a mortgage product that's 75% loan to value. So instead of that vendor saying, on completion, I want you to give me £200,000, the vendor could say, on completion, I want you to give me £150,000. And then with an agreement to, once you've refurbished that property and then sold it on within the next 12 months, you pay them the additional 50. In fact, you probably wouldn't pay them 50, you might give them 60 or 70 just to sweeten the deal for them, which effectively means that they're getting more than £200,000 for their property, and that's the incentive for them. Little things like that, and ways of structuring that deal, the legal paperwork and the way that you negotiate that with people. We go through that, and we include that on our training courses for our franchisees. If you understand those methods, then you'll be in a really strong position over the next couple of years to make a property deal work for you. So if you've got any questions, please ask them now. I'll be happy to help you out. I've mentioned Source Capital, I've mentioned the training. If anybody's going to ask, then the training and Source Capital is only available to our franchisees. Our franchisees are, 160 franchisees across the country. We're a very strong network of people that are involved in property. And to be completely transparent, we did a webinar very similar to this about 2 months ago for our franchisees, because if they're a franchisee, they get the knowledge immediately from us, because that's what they pay to become part of. So let's have a look at the Q&A section right now. I missed the first couple of minutes. Is it possible to get a recording? So yeah, absolutely. The recording is automatically sent out to the email address that you registered with. So you will get a recording of the full webinar. Do you think the cost per square meter for conversion, refurb, new build will decrease in areas such as London or hot areas for properties? That's a really good question, Trevor. Yeah, absolutely. So what I don't think will change will be the materials prices in the next couple of years very much. But I do think that the cost for building the properties will come down. Now, the sort of average, the industry metrics that you get from that are from the big house builders, and the big house builders, their numbers won't change that much. But from the smaller guys that are actually doing the work for people that are doing conversions, people like us, then those costs will come down. So yes, absolutely, I do, but only from labor. I don't think that materials are going to change very much. How high do you see Bank of England rates going, Chris? Well, you know what, to be perfectly honest with you, I haven't sat down and I haven't worked out what I think it's going to be. I've seen the reporting that it's going to go up to 18%. And as you can see from the graph that I showed you earlier, all the way back to 1974, the highest was 17%. So I haven't sat down and worked it out. So I don't want to give you an answer to that, John. But, I know that you are one of our franchisees. So I will try and do that this afternoon in between meetings. And if I get an answer for you, John, I'll send it over. But I haven't worked it out yet, to be perfectly honest. Question from Hitesh: can source capital be utilized for vanilla buy-to-lets, and what are the costs of your finance? Yes, absolutely. I mean, source capital can be used for absolutely any kind of property deal, so long as the deal works. From a vanilla buy-to-let, though, what I would say is source capital is a very, very strong source of finance when you've got a much higher or a higher GDV, because then you can borrow more in comparison to the purchase price. So if you've got let's say you've got a vanilla buy-to-let and you buy it on source capital, and source capital is a bridging finance provider. So these are short-term loans, right? If you've got a buy-to-let that you buy for 100 grand and it's not going to upgrade the value at all, well, 70% of the GDV is the same as your purchase price, so you could borrow 70 grand. So you still need 30 grand in your pocket. However, if you buy a refurb and that you buy the refurb for 100 grand, but the refurbishment value of the property is 200 grand, well, now you can borrow up to 140 grand. So you could potentially borrow all of the initial purchase price and all of the works costs if the numbers add up for that deal. So if you've got a flip, or you've got something where you're upgrading the value of the property, then source capital is a much better fit than just a standard vanilla buy-to-let, because you're probably better off just buying it originally with a mortgage. Greg, that is not a silly question. Do not be afraid to ask. There's no such thing as a silly question, only silly people. I'm only kidding, Greg. Silly question? No, of course not. A vanilla buy-to-let just means a very simple, purchase a property and rent it out to a family. You've got nothing creative going on there. You're just owning that property and renting it out in the most sort of standard, straightforward, uncomplicated way. Turning it into a HMO, splitting it into flats, coming up with a creative way to buy the property. That's or coming up with a creative way to finance the property. That's not seen as vanilla, because you've got an element of sort of creativity and not run of the mill involved in that. So apologies for not describing vanilla early, but I hope that explains it, Greg. Just got a couple more. How does what you are doing fit in with mortgage products? Don't really understand that question, anonymous attendee, I'm afraid. Source capital is a short-term lender. Bridging finance is short-term lending. So normally you would take out buy the property originally, do the refurbishment, achieve that gross development value, that higher value, and then you would refinance onto a mortgage product. That's the standard way for using short-term finance. Anonymous attendee. Okay, apart from being a franchisee, what other requirements, due diligence do you have to adhere to borrow money off source capital? Well, yeah, Richard, I mean, yeah, a really good question and absolutely pertinent, because source capital are only going to lend on deals that actually make sense. So I mentioned the training that we have. We have a very extensive online training platform which covers all of the due diligence that is required. Not only from source capital's point of view, source capital is just the lender. All of the requirement and all of the due diligence that you should be doing should be, you should be motivated to do anyway, because it's your deal. This is your expectation of making, 100 grand out of this product. And you want to make sure that you absolutely will make that 100 grand. So the due diligence that we look for will obviously be comparables. There'll be a surveyor's valuation. And we would recommend that you would go and meet that surveyor with all of your due diligence. So initial purchase valuation, gross development value calculation, written build quotes from builders. When working out the GDV, you'd also want to have floor plans from architects, depending on the size of the scheme. But we take you through all of that. Our training course explains all of that to you. And because we're a franchise, you also have a support person that is by your side to help you put all of that together. You can go to your support person, you can go to them with query. They'll analyze the deal initially for you anyway, before we send it over to Source Capital for you. But they're there to help package this deal with you to make sure that it's in the most competitive way possible to send over to Source Capital, for them to say, ideally for them to say, yeah, you've got everything here. I've got no questions about this. This is the amount that you'll be able to borrow on this deal, for example. So we train all of that. It's not just simply that we say, yeah, come on board with us. You get access to Source Capital, and then we throw you into the lion's den. Of course, it's not like that. We're here to help and support you because we're a franchise. So we're getting into a business relationship with you for the next 5 years. Wow, quite a few questions. And any limits on credit limits based on existing borrowings, mortgages, etc. No, because it's a bridging, basically a bridging company, then they're much more interested in the security provided by the deal itself. So there's no limit when it comes to your existing borrowing. And you can have more than one deal go through Source Capital at any one time. So at one point last year, we had a franchisee that had 3 separate loans, all live with Source Capital. How much will it cost to join up to Source Franchise? Yeah, good question. So that's £12,500 plus VAT. So it's £15,000, and that's for 5 years. So, if you compare that to all of the training courses that are out there, then it's an incredibly competitive amount of money. And then there is a fee, because it's a franchise, every month of £245 plus VAT. One of the things, talking about that £245 plus VAT, it's really important that you understand as well that we're not just here to fund big deals. What we're here to do is to help you start and grow and keep a sustainable property business. So we're here to look at growing your business, and for a lot of businesses, that starts out by concentrating on your cash flow. So we'll look at your cash flow. We'll come up with strategies for you to create and build your cash flow, and then it's up to you to go out and deliver them by having the conversations with agents that we've sort of prepared you for. One of those ways of building your cash flow might be rent to rent, or it might be sourcing and trading deals. We've got a few different options that you can have a look at, and you can choose from. And then we've got the relevant training courses that you can then sit at, and you can go through. And then we've got your support person who then sits by your side to help you put that into place. Are HMOs still a good strategy given the rising energy prices? Paul, that is a great question. Well done, Paul Wilson. I was actually looking at that this morning because I absolutely believe that HMOs are on the return at the minute. And yes, exactly because of the rising energy prices. I'm actually going to record a video this afternoon for our franchisees explaining that is potentially something that they want to look at now before the demand goes there. Because in the next 6 months, I see that the demand for HMO is going to go through the roof exactly because of the rising energy crisis. So the two things that we need to box off there are, first of all, how does the person that owns that property mitigate for the rising energy prices? Is there something that we can do as a franchise across the board to partner with an energy provider to cap costs over the next, period of time? That's something that I'm looking at the moment. But also how high is the demand going to go? What are our expectations of this? So that is a great, really good question, Paul. Thank you for that. I guess you guys have done the DD on the lenders to avoid the sharks in the lending industry who will nick your deals. Don't really know what you mean by that, Jay, I'm afraid. So if you can explain that a little bit better, then by all means do. We're not restrictive with our franchisees, though. Our franchisees can get lending from anywhere that they want to. It's just that with Source Capital, 9.9 times out of 10, they can borrow more from Source Capital than they can from anybody else in the market, and therefore they need less money in their own pocket, or with the money that they've got in their pocket, they can spread it across doing 2 deals at the same time instead of only doing 1 deal at the same time. So therefore they can grow their business faster, which again is a massive advantage. getting through these questions, but they keep on coming. What are the benefits of becoming a source franchisee? You know what, Corey? I'll make a note of your name and I'll get Sam to send out a brochure to you so you can have a look. Essentially, we at Source, we provide 4 things. We provide training, we provide support, we provide leads, and we give you access to source capital so we can provide funding. The training is, very, very extensive. We don't have a tiered system of training. So, like these upsell training courses that you can get onto, we don't have anything like that. As soon as you become a franchisee, we open you up to all of our training courses, which is full transparency on what we've done, how we've made money out of property, and our understanding of the property market across, a number of directors in this business that have been in property for many, many, many years. So we have a complete transparency approach to our franchisees. If we know something, we'll make sure that they know something. So I just thought about the HMO thing that Paul mentioned earlier. I just thought about that this morning. I'm recording a video this afternoon that will be with the franchisees this afternoon. The webinar that I've just shown you, I did for the franchisees 2 months ago, because that's when we first started to see these signals in the property market. And so we made the franchisees aware of it. So not only have you got, very extensive strategy training, support, support from people that invest in property in your local area that can come out, that can spend time with you. We don't have a limit on the amount of support that franchisees can ask for from their local support person. The leads, we generate property leads for our franchisees, and then obviously we've got got source capital. So I hope that answers your question. Obviously, I've not gone into a huge amount of detail, but like I say, I'll get Sam to send out the brochure for you so you can have a look through it. If you have bad credit, can you still become a franchisee and get source funding? Yeah, bad credit, absolutely. Yes, you can, Jason, because like I said, they are looking more so at the viability of the deal and the security that the deal provides, rather than as much attention on the individual as like a mortgage would. Hi, what are the interest rates for source capital? Is it between 1 to 2% per month? Yeah, it is. Yeah, essentially, yeah, it's between. Well, it's a lot lower than 2% per month. It works out to be about 17% over the year, and that is taken by 12%, which is repaid to investors, and 5% as a setup fee. So 17%, but you can borrow up to 70% of the GDV, which is incredibly competitive. Are you able to target a specific locality to generate keen investors through your franchise program? Looking for cost-effective lead generation techniques. Do you mean to generate keen investors? Yeah, absolutely. Yeah. Okay. So we have a number of different platforms that you get a discount to as part of the franchise, where you can be very specific and very targeted as to who you're going to target. One of those examples is Land Insight. So we have a 50% saving if you sign up to Land Insight, just because you're a source franchisee, and that's incredibly targeted and a very, very powerful tool. Answered that one. How do you become a source franchisee? Well, I can get Sam to drop you a brochure. So if anybody else is interested in the brochure, just leave your details, and I'll get a brochure sent over to you. And then once you've had a look through the brochure and you understand the package a little bit better, then you can have a conversation with Sam. No doubt you're going to have questions, so you can talk to Sam and get those questions answered, and then Sam will walk you through the process of becoming a franchisee. One more question here. So if anybody else has got a question, be quick, because after this one, we'll call it a day. Interested in the brochure? Thank you for sending your email address. That's great. So in essence, acquiring more properties below market value is a much more realistic strategy. What could we expect for a property that's valued today, unmodernized, for let's say £1 million? Basically, what could the new price we could offer once this all comes into effect? And more importantly, after refurb, what could it realistically sell for? There's absolutely no way that I can answer that question with any degree of accuracy without actually looking at the deal. And also, there's two things at play. First of all, there's the market value of the property, and then secondly, there's the motivation of the vendor. Now, you might be able to predict that, let's say the property prices, and this is just purely, I'm putting a number here, this is not my prediction. Let's say the property prices come down by 5%. Well, that doesn't mean that we can just look at the value of your property that you're looking at and say, well, take off 5%, because you've also got to take into consideration the motivation of the vendor. And that vendor might all of a sudden, because of his personal situation, become incredibly motivated. And so might reduce the price of the property by 40%, let's say. So you've got to understand not only the market conditions, but you've got to get to know people. How many times do you hear the saying, property is a people game? Every single time an estate agent says, well, I've got 2 different times that you can come for the viewing. You can come on Tuesday and we'll have the house to ourselves, or you can come on Wednesday, but the person will be in, but they're happy for us to have a look around. I will choose Wednesday every time because the person that's selling the property is there. So and you know what, I'll turn up early and I'll stand outside so that person comes out and talks to me, so I can get to know them, so I can get to know their situation. I can find out whether I need to leave the entire sum of the value of the property on completion, or whether I can backdate some of it. I need to know what's going on with their mind and what's their motivation. So I would highly recommend that, that's something that you've got to look at just as much as the market and what the market is doing. Corey, yes, you're correct. The franchise contract is for 5 years, so it's 15 grand. That includes VAT, so it's 12.5 grand plus VAT, and that is for 5 years. So there's, apart from the license fee, you don't have to pay for access to the online training courses. You don't have to, basically there's no upsell. There's no upsell like there is with a lot of property training stuff. Paul, thank you. I will take your email address and I'll pass that on. Timmy Topi, thank you very much. Can that fee be paid in installments? So yeah, we get that question a few times. You can pay in installments, but you'll only become a source franchisee upon the final installment being paid. I hope that makes sense. And then once that final installment's been paid, you'll be able to access the online training. You'll be able to come on the face-to-face induction and so on and so forth. Okay, well, that looks like I've answered all the questions. I hope this was valuable to you. If you did understand inflation and interest prior to this, then I apologize. It was probably a little bit simple, but I think a lot of people are very familiar with those words without really understanding the mechanism that goes behind them. And especially when it comes to being panicked by media and media influence. So I hope that really helps you. So my name's Chris Kirkwood. I am the franchise director here at Sourced, and I am signing off, and I wish you a very happy and successful afternoon. Thanks very much, guys. Thanks for joining me.